In this session, we're going to focus on the auditing of debt and stockholder equity. When we start talking about these issues, one of the things that we need to understand is that most of the work that we're going to do is either going to be from an analytical perspective or a substantive perspective. In relationship to our debt obligations, we're focusing on bonds, interest expense, gains and losses on refinancing, notes payable, mortgage payables. You notice that most of these items can be easily calculated in terms of what we owe and what the interest is based upon a present value calculation. As long as we know the life of the instrument as well as the interest rate, most of this is going to be pretty easy to calculate. When we're auditing debt obligations, the objective is to determine whether all obligations are recorded and properly classified. Some of the relevant assertions include the proper valuation of the premium or discount, and again, this is something that we're going to do based upon an analytical calculation. The valuation of any gains and losses on refinancing, again, a calculation perspective, as well as the proper presentation and disclosure, including important restrictions contained in debt obligations. Most of what we're talking about here is going to be recorded in the disclosures, so we're going to be looking at the presentation of these disclosures. The restriction in debt obligation is aimed at protecting the lender by restricting activities of the borrower. One of the things that we're concerned with as an auditor is, are these restrictions creating an unusual barrier from a financial perspective related to the organization? So as we are considering these debt obligations, we absolutely need to understand what these restrictions are. Some of the activities related to debt obligations include developing a schedule, identifying the periodic payments and interest expense, as well as these debt covenants. Now, the first two items here of bond issuance and amortization, as well as premium payments, the period payments for the interest expense, we're going to set this up at the beginning. So in fact, the same table we're going to use from year after year. We're essentially going to find out where we are in the process in terms of determining the amortization schedule, interest payments, and when these payments are principal and interest, how much of the payment is interest and how much of this is principal. This is going to change every year, but once we set up this table, we're going to understand where these numbers are going to come from, and what we're looking for is any changes. We clearly need to understand these debt covenants, not only from a risk perspective, but also from the disclosures within the financial statements. An indentured bond is a contract between the issuer of the bond and the bondholder. So what we're going to identify is the time period for payment, the amount of interest, whether the bond is convertible, if so, at what ratio. This convertible bond may in fact are diluted earnings per share. Are they payable or are they callable? And the amount that is to be repaid based upon this callable feature. So these are the kinds of things that we're interested in. And since a bond indenture is, generally speaking, a long-term event, so we may have a 10-year bond, 20-year, 30-year, once we've identified this, the information is going to continue every year until this bond comes to maturity. When we're considering stockholder equity, the primary accounts that we're considering include common and preferred stock, as well as treasury stock. We need to understand how much of the contributed capital is additional paid-in capital. We certainly need to understand the dividend accounts, and then retained earnings. But keep in mind, we've already talked about retained earnings from the perspective that retained earnings is a permanent account that comes over from the prior period, and the changes to this include the increase based upon net income, which we've already audited, and the decrease is going to come from any dividends that we pay. So what we're concerned with primarily, again, are any changes in the stockholder account, common, preferred stock, as well as additional paid-in capital. We certainly want to understand if there's treasury stock, if treasury stock has been purchased or resold during this period, or maybe the stock has actually been retired. And then from the retained earnings account, since we've already addressed retained earnings from net income, we're interested in these dividend payments. So what we're interested in is changes. Again, most of this we have already audited from the prior period. Certainly if this is our first audit, we have other considerations. But what we're interested in is any new stock issuance, any new purchases of treasury stock or the selling of treasury stock, the declaration and payment of dividends. We want to understand if there are any granted stock options and warrants, maybe to executives, the exercising and expiration of stock options, transfer of net income to retained earnings. Again, we've talked about retained earnings from an audit perspective. We want to make sure that that net income has been properly transferred through the income summary accounts into retained earnings. And then we certainly want to consider any prior period adjustments that are applicable. When we're considering stockholder equity, what we're interested in is several issues. The first is when we issue stock for non-cash transactions. This is going to create some difficulties as to determining the market value of the stock or the market value of the thing that we received. We want to understand the proper accounting for any exchange of stock for the acquisition of a business. And when it comes to stock options, primarily concerned with the payment of stock options to executives, we want to make sure that the measurement of the fair value of this option is done appropriately so that it's reported not only as an expense associated with our payroll expense, but also is reported appropriately in the equity section. From a presentation and disclosure perspective related to stockholder equity, is what we're interested in is the proper description and disclosure of each class of stock, any outstanding or special rights related to these, stock options and the convertible features, existence of stock warrants, any restrictions or appropriation of retained earnings, and then of course the prior period adjustments and other comprehensive income items. Earnings per share is going to be affected by some of these items. Is the stock warrants may in fact be, we need to make sure that they're calculated appropriately from a diluted perspective. If there is any convertible features, we need to make sure that these are reported in our diluted earnings per share. When we talk about inherent risk, and this is where we're going back to our debt obligations, we're interested in the authorization of the debt. Is whenever there is debt, a mortgage, a bond, is we want to make sure that these items are authorized appropriately. We want to make sure that the receipt of the debt funds is appropriate. And keep in mind that many times the receipt of the debt funds is a transition. In other words, we have an outstanding bond. We are acquiring a new bond with the idea that we are extinguishing the debt or the debt payments. And one of the difficulties related to this is in the prior issuance of debt is that there may have been some of the expenses that were amortized. Well, these amortized expenses need to be appropriately expensed. And then in relationship to the new debt, we need to identify any items that are amortized and the transaction is complete. We certainly need to understand the proper authorization related to this. The recording of the debt transaction, we want to make sure that the interest expense is being accrued and reported appropriately. We want to make sure that everything follows the GAAP perspective. So the difficulty, it's not really a difficulty, but keep in mind that the interest payments are paid sometime during the year. Well, what that means is that there's going to be accrued interest from the last payment to the end of the year. And we want to make sure that all these expenses and accrued expenses are appropriately recorded. Certainly from a mortgage perspective or a debt instrument perspective that is amortized, is we want to make sure that we are allocating the difference between our long-term portion and the short-term portion of the long-term debt. And again, the issue with this is that most of the calculations in terms of determining where these transactions should be are mathematical calculations. So if we understand the terms of these debt instruments, we understand the interest rate, it's very easy to calculate the correct amortization for each year going forward, and as all we're really doing is then comparing that. And the other thing to keep in mind is that if this is a client that we've been working with for many years, once we've calculated that, it really is not going to change from year to year. So we're essentially using the same numbers from the same table in terms of determining these calculations. Any complications with the debt covenants? We need to understand if there's risk related to the debt covenants not being addressed appropriately. We want to determine any calculated ratios accurately, and we need to determine compliance to these debt covenants and what the risk is to the organization if in fact the organization is not in compliance with these debt covenants. These items then need to be disclosed. When we're considering inherent risk, and again, when we're looking at inherent risk, is what we're considering is the risk of material misstatement. From the stock sales and issuance, we're looking for existence and valuation. From the purchase of treasury stock, we're considering this from the perspective of completeness and valuation. So valuation is important because it's the cost of the stock that is subsequently retired and not properly allocated to the appropriate amounts is going to create issues. We need to consider this from the perspective that in many cases is that the treasury stock is purchased and sold in various intervals. So we need to determine if we're using a first in, first out method, which is the appropriate method to use, if we're allocating the cost appropriately related to the treasury stock. When we're considering dividends, we need to consider the existence of these. We need to determine that these were authorized appropriately, that they were approved, and that these items were recorded as transactions in the appropriate period. Related to stock warrants and options, we certainly want to determine the existence, valuation, rights, as well as obligations related to these. We also need to consider the risk factors related to debt obligations. The violation of the debt covenants, if these are not disclosed, this would be considered a risk factor. These debt obligations that are not properly authorized, long-term versus short-term debt miscalculations, interest expense either not recorded, misclassified, or recorded in the wrong period at the wrong amount. Some of these may in fact be based upon fraud of what the organization is attempting to do of managing earnings. Most of this, if it's happening, may in fact be related to an inappropriate calculation. So we need to determine if the entire loan amount is charged appropriately and allocated appropriately between principal and interest. When it comes to fraud risk factors related to stockholder equity, we need to consider the expenses that are charged directly to retained earnings. There in fact may be appropriate transactions there, but we want to make sure that these transactions are done appropriately in such a way that we want to determine that the organization is not hiding expenses and attempting to charge these through the other comprehensive income as opposed to directly to the income statement. Sales stock or issuance are not authorized or recorded. Chances are the sales stock fraud issues are going to relate to the sale of stocks in a transaction where we're receiving non-cash assets. So in terms of the valuation, that's going to be the most significant issue. Stock issuance violation of debt covenants. When it comes to the stock options, we want to determine that these were authorized in accordance with the appropriate terms, that there's no issue related to backdating. We want to make sure that dividend payments are not in violation to any restrictive covenants. We want to determine that dividend payments are paid to the appropriate parties in the appropriate amount, and determine that there's no sales, stock sales that are misappropriated. When we're considering the controls, what we need to consider is disclosure policies and procedures. The board of directors is going to be approving all new debt. Debt interest accounts are updated and reconciled. The review of the financial statements are done prior to the issuance for proper disclosure of the debt obligations. A debt obligation schedule is prepared for each new debt obligation, updated as appropriate, and reviewed by the appropriate personnel. So all of these things are related to the controls. And keep in mind that when we're considering the inherent risk, the fraud risk, and the control risk, what we're considering is the risk of material misstatement that is going to guide the substantive testing related to these items. When we're looking at the equity transactions from a control perspective, we want to make sure that the board of directors approves all stock transactions. CEO and the CFO authorize the approved transactions. Stockholder equity accounts are updated and reconciled. The appropriate review of the financial statements are done with the idea that we're understanding what the disclosures are. An outside party is maintaining a detail of shares issued, repurchased, and canceled, and the accountant researches and analyzes proper accounting for stock option grants. When we're considering analytical procedures, and we're looking at analytical procedures from the perspective of gaining an understanding of the process. So you notice the key word here is planning analytical procedures. What we're looking for is areas where there are potential misstatements. So in this case, what we're looking at is we're looking at trends. We're looking at trends of analysis of the balances of note payable, accrued interest, debt to equity ratios times interest earned ratio, the estimate of the overall expense based upon the average interest rate. Some of these things we might be considering from a stockholder equity account is comparing the current year account balance with prior year balances, as well as earnings per share and so forth. What we want to do is we're using this information to determine the appropriate audit procedures. Again, consider that what we are looking at is we're looking at the risk of material misstatement. So in the risk of material misstatement is we are considering the inherent risk and the control risk. The planning analytical procedures is giving us an understanding of the overall risk areas and is directing our attention to where we need to be looking at. All this information is directing us to the substantive procedures. In the substantive procedures is what we are considering is these procedures to measure monetary misstatement. From a debt account perspective, these procedures are typically going to be these analytical procedures. The transactions are going to be small, dollar amounts are usually quite material, but most of this, once we understand the debt, is we're going to be looking at this from the perspective of doing mathematical calculations. So we're using these analytical procedures as substantive testing. From a stockholder equity perspective, the substantive approach using only tested details is generally appropriate. Again, what we're looking at is looking at a number of equity transactions that is normally small. So the idea is that as we are considering the process of understanding the risk of material misstatement and using this to focus our attention on our substantive procedures, is we're not usually going to do a lot of tested controls. What we're going to be doing is we're going to focus primarily on the substantive procedures where we are measuring monetary misstatement. And again, the reason that we're doing this is the number of transactions is small for both debt as well as equity, and the dollar value is quite material. And the issue that we're using our analytical procedures is because these are going to be very accurate in terms of determining our expenses, our level of account value in our balance sheet from a equity, debt, as well as asset perspective. And by using this, we're going to be able to determine any risk of material misstatement and identify the material errors within the financial statement. Okay, so I've given a very good overview of the way we are approaching the audit for debt and equity, and I look forward to our next discussion. Thank you.